Well, welcome to part two. Let's take a moment to kind of present a little bit of detail about which one of these forms might fit best for certain companies. To begin with, we need to define what business assets of a company actually are. So, what are they? It depends on the type of business. A corporation's assets are separate from the owners. In the other forms of business, there may not be a difference between the owner's personal and their business assets. If you think about a pile of assets, there are two piles in a corporation. The company has its pile of assets, and there is a pile of assets that represent the ownership of the company. In a sole proprietorship, there is just one pile. All of the business's assets and all of the owner's personal assets are combined into one pile. So the technical term is the assets are at risk. So again, what are the business assets of the corporation? The common stock are the assets that belong to the owners. What are the business assets for a sole proprietorship? All the assets, including personal assets. Liability refers to the responsibilities one should one get sued. Of course, you can be sued, anyone can be sued, but what happens in the lawsuit? Well, you can either lose or you can win, right? So if you lose a lawsuit, the penalty is money. There are cash penalties. Where does this money come from? And the short answer is it's the business assets. So unlimited liability refers to business assets considered as part of the owner's total asset package, personal and business assets together. You can lose it all. Unlimited means you can only lose the investment in the business itself. So limited liability, you lose your investment. Unlimited liability, you lose your investment, but you can also lose your personal assets. So, which of these characteristics is most important to business owners? When you choose a type of business, you choose the risk level. A risky business will want to form with limited liability to minimize the chances of losing their personal assets. If you need money, which one is best? Well, it's much easier to raise money in a corporate context. If you're concerned about taxation, which form pays the least in taxes? By definition, the sole proprietorship pays taxes, but only once, so it has the least amount of cash flow that goes to the government in the form of taxes. Now, control is a much more personal variable, right? Many entrepreneurs have chosen the business to have control. They may not want to share it. So they may want to maintain a smaller ownership base, sole proprietorship being the smallest. But of course, maybe they do two or three partners. So when a company decides to go public, it issues what's referred to as an initial public offering. This raises cash and allows founders to harvest some of their wealth. Remember when Facebook went public in 2012? Not that long ago. That IPO raised billions, helping fund the company's future expansion, such as the acquisitions they made of Instagram and WhatsApp. But it's not just about the founders getting wealthier, right? This is a way to provide funds for growth opportunities when they arise. The primary goal of any firm should be to maximize shareholder wealth. Why is this the case? Well, by increasing the value of the company's stock, all stakeholders, including employees and investors, benefit. Consider Alphabet, the Google's parent company. They invest in projects that increase their intrinsic value over time, ultimately increasing their stock price and consequently shareholder wealth. Why do people buy stock? The end goal is to increase their wealth. That is this goal's outcome. If we could not increase the wealth of shareholders, we wouldn't have any of them. Maximizing stock price often aligns with societal good. Companies that grow tend to hire more employees, create more opportunities. For example, Microsoft's strategy of maximizing shareholder value has resulted in high employment growth, satisfied employees, and high customer satisfaction. It's important to note, however, that this goal must be balanced with ethical responsibilities. Ethical companies like Patagonia maximize long-term value while being responsible stewards of the environment. Capitalist societies have long recognized that firms provide many benefits to the economy. They have recognized that for companies to exist, they must have a source of fairly priced liquid securities. So, consumer welfare is high on the list of capitalist free market economies. Fortune magazine frequently lists the most admired firms, right? These admired firms, they have good stock returns, high quality ratings by customers. And they are satisfied employees who like to work there. An agency problem occurs when there's a conflict between the interest of managers and shareholders. For example, a CEO might prefer to focus on expanding their perks rather than maximizing shareholder value. Corporate governance mechanisms, such as board of directors, exist to try to mitigate these conflicts. Consider Wells Fargo. They faced some major governance issues when it came to unethical sales practices, highlighting the importance of effective governance to protect shareholder interests. Value is directly related to the generation of cash flows. What can managers do to impact the values of these characteristics? They can try to find ways to increase the size of expected cash flows. Bigger's better. They can try to develop processes where they can receive cash sooner rather than later. Again, sooner getting your cash flows is better than later. And then finally, they can try to manage the company while minimizing the risk of those cash flows. We want to try to minimize the uncertainty that future cash flows will or will not happen. So again, less risk is always better. So if we can manage those three aspects of business, which by the way is everything about business, then we should be able to have impact on the cash flows of the firm. So we have a definition called free cash flows. There are several different formulas. They all represent the same concept. Some will include changes in working capital as well, right? But free cash flow, as it appears, as it represents cash available for distribution to investors after the company has covered its operating costs and investments. Think about Apple's massive cash reserves. This free cash flow has allowed it to return value to shareholders via dividends and share buybacks, which in turn maximizes stakeholder wealth. At the same time, these massive cash flows are available when opportunities arise so that the company can um, uh, improve products, improve distribution, find new businesses to work in. So that is the second part of this video on intro to financial management.